Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
Good day, everyone. How are you going? Thanks for joining us on the show today. It's a pleasure as you join us as we navigate property investment right across Australia. And, I talk about a lot, the changing fortunes of Australian property, markets within markets, and you only need to pick up the paper or watch the television, get conflicting, contrasting views. And we do like to cover this stuff on smartpropertyinvestment.com.au. So go and check it out if you're not visiting the website. Any questions that you have, we're always quite keen to know as well. You can email the team editor at smartpropertyinvestment.com.au. And on that basis, I wanted to get stuck into some of the feedback we've had recently from our listeners to the Smart Property Investment Show. We do really appreciate you getting in contact with us, and we try and get around to everyone's question. It gets quite hard. A lot of them do come through, but I'm going to dedicate a lot more time, particularly moving up to the Christmas period, to get through some of these backlog of questions, because it just reminds me just how varied everyone's mindset is towards property, different conflicting pressures, different things that they choose to focus on. And it's a really good way for us to spark some talking points to go into. So I hope you enjoy this session, but I'm not going to be doing this alone. I've been fortunate to have in the studio with me my co-investor in the Smart Property Investment portfolio and sometimes host of the Smart Property Investment Show when I'm all around, Alex Whitlock. How you going, mate? You well?
Good, Phil. Yeah, good to be back.
So I've got a lot of questions here, mate, and we're not going to be able to get through a lot of them, but I've got my black pen out and I've put a big asterisk next to some of them, and it's going to give us a bit of a diverse conversation that we can go through. So we'll get straight stuck into it. Just a reminder, this is just mine and Alex's views or interpretations of these questions. Anything we go into today is by no means advice. This is very, very general conversation. I hope with the way that you see how we frame our response to these questions, just the way we view property, but I highly recommend before you're making any investment decision to go and see the right people. And the first question is really connecting with that. And Bridget writes, good morning. I listen to your podcast on a weekly basis and I'm wanting to enter the property market within the next 12 months. Wondering if there was an individual you could recommend that would be worth speaking to about their investment journey that you had on the show. Really good question, and I get this sort of stuff a lot. The fact that you're tuning in to Smart Property Investment means you're looking to open up your mindset when it comes to how you view property, and we're fortunate to get a lot of people on the show around this. Alex, what's your view on this, other than just tuning in to the Smart Property Investment Show? Who should be listening to?
I think that's a really, really good question. And I think the first thing you've got to do, as with any kind of investment, is you've got to assess the person that you are getting your advice from. So rather than making any one recommendation, I've worked with a couple of buyers agents in the past. In our joint portfolio, Phil, we've used Right Property Group. For my personal portfolio, I use Pure Property, but that's because, these guys are in a close proximity to us and, they work for us. What I would say to anyone who wants a recommendation is, I think the first thing is to really start to get a sense for what you're looking for. There's no wrong or right type of buyer's agent. Different buyer's agents deal with different markets. The guys that we work with work for our objectives, don't they, Phil? So
Absolutely.
What I would say is the first thing you want to do in terms of trying to find a buyer's agent, I'd have a look and see, first of all, a recommendation from somebody you know in your area is worth its weight in gold. Real recommendations from friends, colleagues, relatives on someone who's actually got the right outcomes for them is a really solid start. The second thing is have an idea of what kind of asset class you want to invest into. And everyone has their own unique particular goals and objectives in the marketplace. Some of those constraints may be around the amount of money that you've saved, so that may limit your borrowing capacity. On the other hand, you may feel that you want to go into a certain type of asset class. You might want to get a unit. You might want to buy a fixer-upper house. You might want something where you're aiming for capital growth. You might be looking at a cash flow play. So have a clear idea of what you are looking to achieve. Then, when you start to talk to buyer's agents, I think you've got to be savvy. As an investor, you've got to get used to kind of assessing things. So when you're talking to a buyer's agent, ask them about the clients that they have gained success for. Get a sense for how active they are in the marketplace. Have a look at the level of activity they're involved with. How many properties are they buying a month? Get a sense for yourself if they're trying to cater for absolutely everybody, or if they're going to have the time and the bandwidth to look after you because your unique needs are important to you. Have a look at sort of where they're buying at the moment and trust your own instincts as to whether you feel that they stack up. I would also say, I would ask them for a reference from some of their clients. And if they falter or hesitate, I would say there'll be some alarm bells ringing there. So see how confident they are in saying, yeah, look, no problem whatsoever. You can have a chat to some clients.
And Bridget, that's sage advice. And what I would add to that is, having spoken to investors for many, many years, the best investors I know surround themselves with other investors. So your question about wondering if there's an individual you could recommend worth speaking to, go online and there's heaps of forums and other chat communities of like-minded investors, and they have relationships online and they share what they're up to and their fears and their concerns and their challenges and their successes. But some of this is also taken offline. So if you can connect yourself in with a group of investors, I know investors that just catch up for coffee and they shoot the shit.
They'll share their stories.
It's
not a competitive. You're not competing with other investors for properties, but most people, we're all the same. We love it. We love talking about property. I get excited talking to any investor about my investments and about hearing their stories about their objectives. And the first thing that I always do when I'm talking to my friends, when I'm talking to, I've got plenty of friends similar age to me in their 50s who still haven't bought property, and I will recommend immediately people that I've got experience with. And I think that's a really good point. I'd also just sort of like to add, you need to look and make sure there's another reference point in terms of being a PIPA member. So you need to make sure that they are, a member of an association. It's just that other level of comfort that they are actually part of, some sort of body where they've got some sort of responsibilities.
And this is the balance, right, Bridget, to be leaning on the experts, and Alex ran through some very good ways that you can find the right people right for you, but blend that with the property investor story and connect in with people, and they will share their insights. And, my recommendation would be share some of your goals with them as well, because it can just help you just socialise what they are and keep you a little bit more accountable. But let us know how you go on that journey and who you track down, Bridget, right back in. Next question. It's a bit of a longish one. I'll try and condense or paraphrase it. This is from Anonymous. It says, hi, just listen to the podcast on properties in Sydney and market trends. What are some of the things to look for when selling, e.g. what type of real estate? There seem to be new versus old sales people. Interesting question. We get into that. While I was looking, I noticed the new style apartments are made for the young that have nothing to store, where old style are bigger for people that like that space. So I think what this question is really getting into, Alex, is, how do you go about determining the type of property that's right for you? Now, you've got a lot of concerns and challenges.
From an investment perspective.
From an investment,
yeah.
Particularly around, this question here is around apartments. There's a lot of concerns around apartment space right now in that there's been a rapid spate of building. There is a sentiment that some of the building quality has been compromised by some poor building. There's also a whole issue around fire ratings and cladding. But then the costs associated with holding these new type of assets, investments versus, let's say, sort of more 1960s, 1970s red brick sort of 2 up, 3 down type things, which are easy to hold and you don't have any challenges around some of the potential building defects around it. So when looking at an apartment to purchase, how do you go about, or what do you see the best investors do approaching those type of decisions?
Really good question, and a very tricky question to answer. And I would say that in terms of sort of newer versus old, there are people far better qualified than me to go into details about depreciation and some of the sort of the tax benefits with different kinds of assets. I'm not qualified to go into that particular area. What I would say is, again, and with any kind of investment, I think the first thing is you need to have a look at what your goals are. Now, look, we all invest in some shape or form or other to make money in the future. But I'd have a look at, in the short term, whether it is a capital growth play or whether you're looking at sort of you need something that's at the cash neutral type area. I would also have a look and see vacancy rates are critical with apartments as they are with houses. So in the area that you're looking to invest, I would have a look at the levels of vacancy rates and try and identify which types of assets are the ones that are sitting vacant and which ones tend to be most desirable. And there's a very simple way to go about doing that in the absence of, sort of anything structured. And that's to phone up. I'd go to local real estate. I would speak to the property management department. I would have a chat with the property manager. I would say that you're looking to make an investment in that particular area and you're looking to buy an apartment. And what kind of apartments, first of all, rent the fastest? What kind of apartments tend to get the best rental return? And what kind of apartments tend to be sort of the best tenanted? And they'll give you a picture, Phil, whether it's going to be some of the older buildings. And as you quite rightly point out, I just recently bought a 2-bedroom investment property down in Newport, just up on the northern beaches in Sydney. And it's probably a 1960s building, but it's got 2 car spots. It's got significant storage within the car, downstairs in the sort of in the under sort of property garage. And again, that makes that an attractive proposition. There's there's an older couple who've gone in there. One of them's working, one of them's retired. But the fact they've got sort of plenty of storage there, there's also that particular property has a separate laundry. It's an older style building, but with that comes, a more solid building. You know what? You just know that it stood the test of time. It's been there for, for many decades, and that you can see I've got a good and thorough report on the building. I know that it's going to be good for the next significant period of time. So for me, that ticked the boxes for me for my investment.
And I'm conscious to echo your sentiments. We're not really qualified enough to make recommendations around the type of units or the type of apartments you should be looking at. But there is a lot of people who are, and fortunate they do produce a lot of content for us on smartpropertyinvestment.com.au. So I'd highly recommend, all you got to do is just go into the search field and write which type of apartment should I buy, and you're going to find a whole bunch of articles in there. So I'd like to direct you there. There is a big difference between new apartments and existing apartments. A lot of around holding costs as well. So it's not just about the asset base and the capital growth over time. It's what it's going to cost you to hold on to that moving forward.
I'd also add as well, depending on, it's a bit of a broad term, new versus old, because newer apartments, I would say I'd be looking at whether they have, whether they're sort of high-rise apartments with lifts, with areas that require maintenance. And speaking from experience, the first properties that I bought were off the plan, brand new builds. They, in terms of capital appreciation, they did well. They're in the South Bank in Melbourne. I was very pleased with the way that they grew in value. However, being very naive and being sort of new to property investment, I had not realised the very significant costs around body corp. So maintenance for lifts, maintenance for public areas,
probably
maintenance for swimming pools,
there,
tennis courts, and so forth. So my cash flow, my cash flow was very, very poor from those particular properties.
Nice one. So we're going to move on to the next question, and it's an interesting one. And I'm not going to go there straight away. I'm going to go to a quick break. Back in a moment. Welcome back, everyone. Here with my co-investor across the Smart Property Investment Portfolio, Alex Whitlock. We're getting into some Q&A stuff, so we're going to do a lot more of that. Make sure you send your questions through. It's going to be a big focus for us over the summer period. I know a lot of people use late December and January when they've got some time off to binge on Smart Property Investment Show podcasts. It's a real privilege to be able to be delivering these to you. So send your questions through. We'll answer them, and hopefully we can answer yours on air. This question is from Mitch Elliott. Mitch, thanks for writing in. Question Mitch has is, I'm a 28-year-old property investor with 4 investment properties throughout Queensland and Victoria. While listening to Phil and his podcast talk about his portfolio's tracking and being able to talk about it right down to dollar values and percentages, it has made me want to take a more active approach to understanding the performance of my portfolio. I've searched for some property management spreadsheets, but have not been able to find any advance as what I want to. Phil, have you got any way you can share your spreadsheet with us, any other information? Mitch, good question. And I get asked this question a lot around this spreadsheet that we use for managing the Smart Property Investment Portfolio. It's something that I made over time. It's a bit of a Frankenstein's monster now, but it pretty much gives me any information I need at any given time. So it's right for me.
It's not the prettiest thing, but it is very, very effective. And it has been built. And the great thing about the spreadsheet that you use is it's been built specifically around absolute transparency of all costs. We have talked in the past about actually creating this into some sort of a platform we can make available to our listeners, and that's something that I think in the future we've talked about it a lot, haven't we? But we've just not got around to doing it.
It's a huge benefit for it, and I get asked a lot, and it's not really the mechanics of what the spreadsheet is; it's the decision making power it gives me through the information that's within it. So, some people are really onerous when it comes to this stuff. They need to know every little bits and bobs, and I'm one of those people, whereas other people are just happy to let it fly. But you need to actually understand in your portfolio what you need to know about it in terms of giving you greater capacity for making decisions around it. So you might be happy with it, you don't want to grow it, and it can just tick along and do whatever it wants. You might be wanting to really map what sort of equity you have in the portfolio so you can look to refinance and purchase some more, or you might be thinking about cash flow. So our spreadsheet around our portfolio is built for the purpose of what we need it for, but we will make it available at some point in time. So Mitch, watch this space. The point I would make from your question is that you want more of an enabler to help you keep advancing down your journey as a property investor. And I'd say that's very good. Property is not a static investment. It's not something you can set and forget and walk away and leave it alone. The best investors I know are always assessing or having a process for assessing their portfolio at any given time, allowing them to make good decisions when they need to. Now, when you look at this current market, it's the cheapest interest rates have been in many, many years, or if ever.
I'm telling you, it's just on that point, I've been investing in Australian property for more than 25 years. These interest rates they're just unbelievable. I was doing a podcast earlier with Mortgages Crew, talking about serviceability calculations from CBA. It's now sort of around about 5%. I mean, that's just crazy low. This is about your ability to kind of continue to meet your mortgage repayments. So it's quite phenomenal. Just interested in Mitch's question. One thing I'd like to highlight is a spreadsheet or a platform is only as good as the information that you put in.
Absolutely.
And I think one of the things that makes Phil particularly good as an investor is his absolute attention to detail around the data we put into our sheets. And we look in through a microscopic view on every single little cost. And we're also very realistic about the property values, because that's a big tool in terms of estimating how much equity we've got that we can move forward. So I'd be really mindful not only of what functions and features a particular tool has, it's what information you put in, how honest you are with yourself and how accurate you are with what you put in.
And when you look at this current market, and for investors that are looking to capitalise on what is, and to my opening remarks, open up any paper and you'll see what's going on in Sydney, Melbourne, Brisbane, etc. The best investors are those which are prepared irrespective of the market conditions. But when you look at where we are right now and the fact that serviceability constraints are starting to lessen, banks are having a greater appetite to lend, money's all-time lows, cheap. If you want to capitalise on the market, now might be the good time. I'm going to do one more question before we go to another break. This is from Richard in Sydney. Thank you, Richard, for writing in. Remember that email address, editor@sparkpropertyinvestment.com.au. Send your questions through. We'll get around to it. And I'm happy to answer absolutely anything. And what I might do is I might aggregate some questions which are of similar themes and get some of our partners within Smart Property Investments in buyers, agents, accountants, etc. to help us answer them. So Richard writes, hi Phil and team. Firstly, massive thanks for increasing my knowledge base in property investing over the last few years. You have really given me more confidence to better decision making. Secondly, I'd love it if you could put together a podcast on either of these. Number one, pros and cons of different loan strategies, principal interest versus interest only. We can touch on that right now. And pros and cons of purchasing in trust format versus your individual name. Yes, I'll put something together that from an accounting perspective, but I'm happy also to share our view on this. Richard, appreciate the feedback. That we do this because of exactly that reason. We want people to make more informed investment decisions. So I get a real kick out of the fact that we are contributing to you as a better property investor. Alex, first question, pros and cons of different loan strategies, principal and interest versus interest only.
Very interesting question. You've got to look at why you structure things in a certain way. Australian property has very much been based on a capital appreciation play rather than a cash flow historically, certainly in some of the more expensive markets, Sydney, Melbourne, where you've typically had lower yields. And so there was a sort of an approach around negative gearing that you're going to make your money through the growth of the property. And so you'd forego some of the cash flow, and the negative gearing would help sort of plug that gap through claiming some back through tax. I do say that it is not a good strategy. And I think there's a bit of misunderstanding around negative gearing, that in a very, very, very few cases, i.e. very, very high net worth individuals, you may get a tactical strategy about to actually lose money. But for most Australians, why would you want to lose $2 to make $1? I would say that you need to pay the property down at some point in the future if you're planning on holding it. If, on the other hand, you're looking at a capital appreciation play where you want to acquire and hold as many properties as you can to build up that equity, and then at some stage or other, actually look to kind of sell off a proportion to pay off the rest of them, or maybe liquidate the whole portfolio and realize your gains. I think you've got to know where you want to go with your property. If you're buying, are you buying multiple properties? Are you looking to buy just one property? If you're looking to buy one property, the goal has to be to pay the loan off as fast as you can, unless there is some very significant tax reason why you need to be highly, highly negatively geared.
And these two things, we're talking about, you're getting very technical talking about principal interest and interest only. You've got to think about the strategy of what you're trying to achieve, as Alex mentioned. And these two things work in lockstep. Property is a game of finance, and it's a game about what assets you choose and where you choose to do them. So I'll be leaning on your mortgage broker and any other property strategies you may be using to help make those decisions at any given time. And depending on who you are, it's going to be different.
Can I just add something, Phil? Sorry. With interest-only loans, if you're operating in a flat property market, then you never pay down the principal of the property. So effectively, and if you're in a flat market, i.e. there's no capital appreciation, you end up continually paying out interest. You never pay down the property, and you can end up technically, sort of never reducing, never actually owning the property. So you've got to think very carefully about the impact of that debt and, and your eventual ability to generate, sort of dollars in either cash flow or in value from that property.
That's a really good point. And Richard, this question around operating or investing in a trust or an individual name is a really important question, and something that I've grappled with over many years. And I'll get into that back in a moment. Welcome back, everyone. We're chatting through a lot of the questions coming through, editor@smartpropertyinvestment.com.au. I'm here with the co-investor of the Smart Property Investment Portfolio, Alex Whitlock. We've just been chatting about principal interest and interest only. It's a strategic thing. Go and speak to your mortgage broker and your property strategist to work out what's right for you. But this whole question around whether or not you invest in a trust or individually, the answer to this, and again, this is by no means any advice, this is my personal view of it and own personal experience with it. It depends on what you're trying to achieve. Now, the Smart Property Investment Portfolio, as we've written about and spoken about for many, many years, that all sits within trust formats, actually across a number of different trusts. And we've set that up for a particular reason, longevity of the portfolio, the way we can distribute income, asset protection, all this sort of stuff. But then when you look about investing, what you do individually, Alex and I do individually, a lot of the stuff we hold outside of that portfolio is in our own individual names.
That's right. And I think, we've got our reasons for holding our joint portfolio in a trust as much as anything, because we're joint investors in that. We also we have business interests through Momentum Media and so forth. So there is good reason for that. I think you need to speak before deciding where you want to go. You need to speak to an accountant. You need to understand all the ramifications of how to structure your portfolio, because there is a right structure for a right strategy. There's no one situation is better or worse than the other. It all depends on what your own personal circumstances are, what your goals and objectives are. Just because something is in a trust structure doesn't mean that you can necessarily sidestep any costs. In fact, in some instances, you can end up paying more out through the trust structure. So you need to look at your own circumstances. As you mentioned, Phil, for outside of the portfolio, look, I personally don't use my trust structure for my own investments. It's just a choice. It means that I can move a little bit more nimbly. There's a bit less admin involved. Look, whether that's right or wrong for me, I don't know. It's something I'm quite comfortable with, my own portfolio. I've got 4 properties outside of our joint portfolio.
Every single accountant I speak to when this question comes up, and it's something that every accountant sort of touches on at some point in time, they say if you can avoid investing in a trust, try and avoid investing in a trust, because it comes with a lot of headaches that you don't get investing in an individual name. And I'll touch on something Alex mentioned. When you look at the Smart Property Investment Portfolio, because every property we own within those trusts within New South Wales, we pay land tax on the very first dollar. So we get no land tax break on that. And that is to the tune of sort of $30,000+ it costs us, in addition to the portfolio that you wouldn't be paying out if it was held in the individual name. So these things swings and roundabout. What's right for you is going to be specific to you, and make sure you go and get advice around it, because once you go down a particular path, it's often hard to unravel it, and it can be very expensive to do it. So, get it right from the get-go.
And I would also go a step further than that, Phil. You need to have very watertight advice. And once you get it, trust structures is not black and white. There are different types of trust structures. If you get bad advice around how to structure things, you can end up in a real mess. And, you can't get the genie back in the bottle once you've started setting up these structures.
Yeah, and setting up a trust structure is not about today. It's really about what the future is going to look like. And, I know a lot of people, they invest in property because they love property, but let's be frank, we're here to make a few bucks out of it. So you've got to be thinking about when you're going to realize that investment in time. It might be 5 years, it might be 40 years, but you want to be choosing a structure which is right for you today where you can, but looking for the future. So when you do choose to liquidate, retire on, however you want to realize the value in your property portfolio, the structure allows you to do it. I'm going to close with this question, Alex, and this is from Hilda. Thanks for writing in, Hilda, and I share your pain on this. It's the reason why I've chosen this particular question. Hilda writes, Dear Editor, I've heard your podcasts. They are very good and well presented. Thank you. Well, thank you, Hilda. I do appreciate the feedback.
She's talking about the ones when I'm in stepping into
Absolutely.
you.
Absolutely. I've got a lot of hate mail these days. I'm bullied on social media. Anyway, but on that note, don't bully me on social media, but if you like what we're doing with this, can you please keep these reviews coming on iTunes or whatever platform you do listen to this podcast? As I mentioned beforehand, it's a big team behind me here. I'm just the guy on the microphone who are very passionate about delivering these podcasts. So they get a real kick out of the feedback as it comes in. So please send it through. It's really, really easy. Just press the review or comment button wherever you listen to this. I digress. Hilda writes, I have a query. I'm not sure if you invest in Logan, Queensland. I do. The council rates seem to be the highest in the country. My last quarter for a very modest house in Heritage Park, no more than 450 square metres of land, was $900 odd. The big item seems to be water and wastewater items, more than $350, and the council general rate, residential 2 around $300. Does anyone have the same problem? Yes, I invest in the same area, and I too are paying those similar rates. basically, you got to remember they aggregate water and council rates all together in the Logan Shire. So maybe that might be a bit of the hurt. You've got a feeling that you are actually paying it all together, but it is aggregate. This comes down to cash flow. You know, when you're looking at a particular property, yes, one of the big questions is going to be whether or not it's going to grow in value over time, but you've got to be thinking about the holding costs for any given asset. Alex spoke about some of the stuff that he bought early on in his investment journey down in Melbourne around really expensive body corporate rates to hold those assets, which can impact on cash flow and therefore the ability to hold the property. So when you're assessing a property investment, think beyond just capital growth about whether or not you can hold the property, because if you want to transact or think of property as a commodity, buying one year, selling another, I don't know too many people that get too rich doing that stuff. Those people that hold on to properties for as long as possible are those that realize those benefits. So that would be my recommendation. Alexander, what's your thoughts on all this?
I'm probably the worst person to speak about in terms of council rates. It's something that I wouldn't look at too closely. I'm probably guilty of not considering that type of consideration. I think, Phil, you've hit the nail on the head. I think you've got to know what your objectives are. And for a lot of us starting out, cash flow is a really critical issue when buying property. We scrape all the money we can together to get that deposit. Everything's geared around getting that first investment, and it usually leaves us, sort of a little bit lean. You're probably going to be looking at a shortfall in terms of your mortgage versus the income you've coming in. So things like, as you say, council rates, and then back to sort of the previous question around whether you have a trust structure, so forth. These are all things you've got to factor in. You've got to look at what you can afford to manage on a monthly basis to hold the property. You've got to look at what your goals and objectives are. Are you buying a property because there is good data to suggest that will have gone up 30% in another 2.5 years' time, 3 years' time? How are you going to make your money, and what are the costs associated with, going down that journey?
I hope you enjoyed that, everyone. We get a real kick out of answering these questions, and it's interesting the way that myself and Alex will respond to these will be very different to how other people do. People who are accountants, lawyers, buyers agents, the other A team that people have as part of their property team. So we're going to make sure we get more of them on to help answer these questions moving forward. But all I ask you to do is send through any of your thoughts. We're happy to answer them. And as this community of property investors continues to grow, more and more people are being educated and hopefully making more informed decisions, as we've spoken about beforehand. So please write in, editor@smartpropertyinvestment.com.au. You can also leave any questions that you want on social media, wherever you choose to engage with us. Just search Smart Property HQ and you can track us down right there. You can send us a direct message or do it live as a post. We're happy either way. Alex, thanks for coming in and sharing your insights on these questions today.
Thanks, Phil.
And we'll make sure we're back again soon. You're going to hear a lot of us over the Christmas break. So start saving up your podcast now so you can binge on them, hopefully over a pina colada sitting somewhere on the beach. That's where I'll be spending hopefully some of my summer. We'll be back again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.